Silvia Ardagna is the chief European economist at Barclays, and she joins us from London. Welcome to the show.
Thank you very much for having me.
So I want to get your reaction to the ECB, as the Federal Reserve, comes under fire and criticism, for trying to make up for lost time by going on this aggressive path of raising rates as inflation soars, possibly causing a recession. But in the ECB's case, does it have to tread carefully here in a different fashion than the U.S.'s Federal Reserve, given, all the scars left by the Eurozone sovereign debt crisis a decade ago?
Yes, definitely. I think the ECB has also to be very careful. First and foremost, because economic activity is weakening. So we have actually even a worse outlook than in the US. The energy crisis is a big supply side shock, and demand has never been as strong as in the US. So we forecast a recession in the euro area where the peak to trough decline in GDP is quite deep. Second reason, as you mentioned, the ECB has to be cautious because of the risk of financial fragmentations and the possibility that obviously the tighter the monetary policy, the higher the risk that investors become concerned about the debt sustainability in high debt countries. And also higher policy rate reduces the potential fiscal space left that these countries have, which is still in part needed to mitigate the cost of this energy crisis.
The ECB, it's already seen as kind of being late to the party being the rate hiking party. So is the cautious approach too risky, though, because it means inflation will persist even longer? What about just pulling the Band-Aid off? I mean, you're looking at 9.9% inflation here.
Look, we disagree. I don't think the ECB is late to the party. If anything, they have done quite an aggressive shift. They have started reducing QE from the beginning of the year. And inflation in the euro area is very elevated, but is of a different nature. It has really been driven by this energy shock, by the supply side shock. It's in terms of trade negative for the euro area as a whole. And we have not seen in the euro area any significant wage increase that basically lead us to think that there are second round effects. Just to give you a sense, average nominal wage growth in the euro area is tracking at 2.7% year on year. So in real terms, there is a very big squeeze. So in our take, we have a different takes. We actually think that today, a more dovish outcome that the market expected was, was an appropriate shift, if you say so. I mean, we expected 75 basis point of hike at this meeting. We expect 50 at the next one, and then two hikes by 25 basis points. So we were forecasting less hikes than the market was pricing. And I think the ECB sent the message that an aggressive shift has been done, and that we know that monetary policy acts with lags. So let's see what this tightening in financing condition will bring about. Probably we think in December, when the ECB will release the new forecast, they will set up inflation for 2025, going back to 2% target. And again, I think it's very feasible, given the fact that the domestic economy is weakening and that there is no wage price spiral.
Do you think the ECB made a mistake by not engaging in any quantitative tightening?
No, again, I think the economic conditions in the euro area are different, and engaging in quantitative tightening has its own risks in terms of financial fragmentations. They announced that they will make a decision at the December meeting. We expect that starting from next year, probably in March, when they finish hiking rates, they will begin to reinvest only partially the maturing securities.
The ECB does have a difficult task of setting monetary policies, for 19 different countries. Some of those countries have fiscal wiggle room, others don't. Is there anything else the ECB should be doing to try to get a handle on record inflation?
Again, I think the ECB again is doing, it's very uncertain economic outlook. Inflation is driven by a war, by an energy shock, and there is very little that the ECB can do. The ECB can control interest rate to try to avoid that inflation expectations become disanchored, and to try to avoid that there are wage price spirals. But it's very difficult with an economy that is weakening, that wage growth will become so entrenched that that would lead to a disanchoring of inflation expectations in our view. So overall, I think that the ECB has now brought rates into restrictive territory, or neutral to restrictive. It will continue to look obviously at the evolution of the data, both on the activity and inflation front. But so far, I would say so good. I mean, there has been an aggressive increase in interest rates, and there has not been much of a widening in spreads between core and peripheral markets, nor disorderly movements in financial markets in general.
Silvia, you mentioned energy shocks. Do you think that countries will have the fiscal space to deal with this issue?
Well, this year they've had quite a lot of fiscal space. They've taken, large fiscal measures of the order of 2.5% of GDP at the euro area level. But again, this has to be contrasted with the 5% terms of trade shock. Next year, I think the fiscal space will be less so, and this because of a variety of reasons. One, as I said, the economies are weakening, and so tax revenue is likely to be lower, but also the automatic stabilizers imply higher spending. But the cost of funding has gone up quite significantly. So they will still be able, I think, to retake some of these measures that will expire, so extend some of the measures that will expire at the end of the year. But certainly the high debt countries will have to be much more careful in accommodating the energy shock.
Okay, Silvia Ardagna with Barclays. Thanks so much for your perspective today.